Okay, let's quickly look at an illustration to um, absorption costing, right? Don't forget that absorption costing is a traditional way of absorbing overhead, right? Or conventional system, right? Now, we will look at an illustration. Now, let's quickly check what is the requirement. Required, prepare the actual profit and loss statement for each of the 2 years using absorption costing. Provide a reconciliation of the under absorption costing and marginal costing, which means that at the end of after preparing the marginal costing as well as absorption costing, my previous video we're able to explain that with an illustration. Then we will now do the what? The reconciliation. Now, the computation. Now, let's quickly look at a question here. Last Chance manufactures a specialist photocopier. Increased competition from a new manufacturer has meant that the company has been operating below capacity for the last 2 years. The budgeted information for the last 2 years was as what follows. We're given the budgeted information as annual sales, selling, direct costs, variable production overhead, fixed production overhead, right? Now, we're also given the actual result for the last 2 years is as follows, right? The annual sales, production, direct cost per photocopier, variable production, fixed production, overhead. Now, there was no opening stock at the beginning of the year. So in this question, it was stated that there was no what? Opening stock, right? Now, we start with what? Sales, right? Sales. Right? We start with what? We start with sales. Sales. Right? Now, what is the sales? Is the actual, right? Is the actual. What is the sales? The selling price is 50,000, right? Is 50,000 times the production, which is 30 units, right? Which is 30 units for year what? For year one. So we can have this times this. So this is 1.5, right? From our format. Now, absorption costing, don't forget, is just like your normal P or L account, right? Your profit or loss. Now is cost of sales, right? So there is opening inventory. Now, don't forget that in absorption costing, you value all your production costs using what? Full cost. The full cost is the combination of both your fixed cost as well as what? Your variable costs. Now, there was no inventory at the beginning of what? Year one, right? I actually taught us how to determine the determination of opening and closing inventory, right? So we'll still repeat that in this question. Now, that is not given, right? So what next is the production cost? Right? So we need to value it at what? At full cost. Now, we can have here as our workings, right? We can use this here as workings, right? Work one, year one, or we say determination of full costs per unit, right? Full cost per what? Per unit. Year one, year 2, right? Determination of full cost per unit, right? Now, for year 1, the variable cost first. Let's pick the variable cost, actual, right? So we have direct cost per photocopier per 1. That is why it is called unit cost, right? Unit cost. This is 20. Why this is what? This is also 20,000, right? What next? Variable production overhead, VPO, variable production overhead, right? 11,000. This is for 11. This is year 1 is 11,000, right? Year 2 is what? 12,000, right? So this is just the variable cost, right? What about the fixed cost, right? Don't forget it is full cost. So your fixed cost per unit slash OAR. Don't forget that your overhead absorption rate is also known as predetermined rate or fixed cost per what? Per unit. So this will give us the full cost, yeah, right? Full cost. Now the question is, how do we determine the OAR, right? OAR is what? Your budgeted fixed overhead divided by budgeted levels of what? Activity, right? Now, overhead absorption rate or overhead absorption rate is equals to budgeted fixed overhead, right? Budgeted fixed overhead divided by the budgeted what? Level of activity, right? Budgeted level of what? Budgeted level of what? Activity. Don't forget that it depends on the company basis of what? Absorption. Now in this question, now it was not stated that they absorb their overhead on the basis of either machine hour or labor hours, but we were given the unit produced, so it is assumed that their overhead absorption rate is on the basis of what? Unit produced. Please always look for that in the question. It is always stated that this also company absorb their overhead on the basis of labor hours or machine hours or the unit what? Produced. Now, what is the budgeted? Fixed production overhead? This is 525, right? Budgeted levels of activity is what? 70 units. 70 units. So what do we have? 525 divided by 70. So this is what? 7,500 per photocopier, right? So this is 7,500, right? 7,500, and we have 7,500, right? So addition of these two, this is 38,500, and this is what? 39,000 what? 500, right? Now in this case, now the actual profit will be based on the production cost, will be based on the actual production, right? So what is the actual production for year 1? Is 40, right? Is 40 units. So let's quickly check the full cost, right? The full cost is 38,500 times 40 units, right? Times 40 units. Now, 38,500 times 40 units. So this is 1,540,000, right? 1,000,000 what? 540. Now, what next? From our format, we can still have the closing inventory, right? closing inventory, and it will still be at full cost, right? At what? At full cost times this. So we need to determine opening and closing inventory, because we already told that at the beginning of year one there is no open inventory, right? Now, how do we determine that, right? We need to quickly determine that. So this will be your work 2, right? You can have determination of opening and closing inventory, right? Opening and closing inventory, right? So year one and year 2, right? Inventory is always in units and in what? In units, right? Now, opening inventory, this will be nil because there was no opening inventory in what? In year one. Now, production, what is the production for year one? They produce what? 40 unit sales. In unit, what is the sales? In unit, 30. So definitely there is a closing inventory. You produce 40, you sell what? 30, right? What do you have? This is 10. There is closing inventory of what? 10 units. Don't forget that the closing inventory of this will be opening inventory of year 2, right? So this will be what? Opening. So what is the production? Production will be 60. The sales is what? From the question, the sales is also what? 60. Now, this is 60, right? 60 plus 70, 60 plus 10, that is 70. 70 minus what? 60, that is 10. So the closing for year 2 is what? 10 what? Units. Now, the closing for year 1 is what? 10 units, right? So 38.5 times 10. So this is 38500, right? Now, you add this, you subtract this from this because this is closing inventory, right? So you subtract this together, what do you have? 40 minus 385. So this is 1155. So you subtract this. So when you minus this, what do you have? You can have, okay, this is 345, right? 345, right? Now, assuming there is variable selling overhead, you will still deduct your variable selling overhead before you have your what? Your gross profit, right? Now, you can still have gross profit. Now, this is what? The gross what? Profit. Don't forget that the closing inventory of this will be opening inventory of this of year 2. Is that not so? Now, what is the sales for year 2? Selling price is 50,000, right? What is the unit? Is 50,000 times 60. 50,000 is the selling price times the 60 unit. The 60 unit is the unit sold, right? So this will give what? 3 million. Now, the opening inventory now. The closing inventory of year 1 will be opening inventory of what? Of year 2. So you can have here. So where is the opening inventory? So opening inventory will be what? 385. 385. You can see here, right? 38 what? 385. 385,000. Now what is the production? Production, right? What is the production costs? For the full cost here for year 2 is what? For the full cost is 39,500 times. Now, what is the unit produced in year 2? Right? The unit produced in year 2 is 60 what? Units. Class, are we still together? Right? So this is 395 times 60. So this is 237. Right? 2,370,000. Now, what is the closing inventory? Don't forget that you still value your closing inventory at what? At full cost. The closing inventory, 10 units, then the cost is what? 39,000 what? 500. Now, 39,500 times 10 units. Right? Times what? Times 10 units. That is the what? The closing inventory. Right? Times 10. This is 395,000. Okay. So we can have 385 plus 2370 minus 395. So this is 2,360,000. Right? So what is the difference? Minus 3 million. So this is what? 640. So you can see that this is our what? The gross profit. Now, the next step is to determine if the overhead is over absorption or under absorption, so that we will know if we are adding to the gross profit or subtracting from the what? From the gross profit. Now, okay. Determination of over / under absorption. Right? Determination of what? Of over / what? Under absorption. Now, year 1, year 2. So what is the opening? What is the actual production? Actual production or actual fixed production overhead. Let's say actual fixed production overhead, right? Overhead. So what is the actual fixed production overhead? Actual fixed production overhead. 500, 530. 500, 530. Right? 500, 530. Now, what is the overhead absorbed? Overhead absorbed is calculated as what? As the actual product. Is calculated as actual production times the OAR. Now, some students in this question now, they will actually use the budgeted overhead, budgeted fixed overhead, which is wrong, because budgeted overhead did not have element of actual, so you can't compare the actual and budgeted without having what? Anything in common. You can see that the actual production overhead will be inclusive here. Okay, it's already inclusive here, right? So that is why you can be able to what? Compare them. So when we get to variance analysis, we'll still talk more on over and under, right? Now, in this case now, this is the actual production overhead. This is how it is being what? Calculated. Now, what is the actual production for year 1? Actual production for year 1 is 40 units times the overhead absorption rate that is being charged to that production, because an overhead absorption rate is the rate that is being what? Charged to what? That particular production, which means that if even you are producing anyhow, if we don't want to know what you are producing, right? we will pay you this specific amount, right? So what is the OAR? The OAR is what? 7,500 per what? Per unit. Per what? Per unit, per photocopier, right? So this is 40,000, 7,500, right? 7,500. So 40 times 7,500. So this is 300. Right? So the question now, the difference is what? 200. Now the question now is, don't forget that this is a cost, right? Now, we will tell you that this is what we want you to use, irrespective of your production. We will pay you this amount, which is 300. Now, you now use, is a cost to the firm, don't forget. And you now end up using what? 500,000 as what? As the cost. So the difference will be charged as loss, will be expense, right? Will be what? Will be expense. Now the difference will be what? Will be expense. That is an under absorption, right? That is an what? An under what? Absorption. It will be chargeable to what? Your expenses, or you can deduct it from your what? From your gross profit. Now this is an what? Under absorption. Right? Now let's quickly check for the second one. Let's quickly check for the second. Year 2. For year 2. Right? For year 2. Year 2. Right? Year 2. Year 2. Right? What is the actual? Is 530, right? So the actual production for year 2, what is the actual production? Is 60 units times the 7,500, right? 60 units times 7,500. This is 450, right? This is 450. 450. The difference is 80,000. Now the 80,000, is it an over or an under absorption? It is still the same thing, right? We tell you that this is what we will pay you. It is the cost to the firm. Don't forget, it is a cost, and this is what you end up what? Using for the what? You end up using for the what? For the actual what? Production. So it will be a cost. That will be an under absorption, which means that both of this absorption is under absorption, which will be deducted from the gross profit, or will be used as what? As expenses, right? It depends on the treatment. So this is what? Under absorption of 200 as well as what? 80. Now, expenses. So do we have any other expenses apart from fixed production overhead? Don't forget that since you've used the fixed production overhead as a full cost here, so you don't need to bring fixed production overhead. But if there is fixed selling and distribution, you can still bring it because it is an what? An expenses. Fixed selling and what? And distribution. Fixed selling and distribution. Right? So in this question now, do we have anything like that? Fixed selling and distribution? No fixed selling and distribution. Please don't bring in fixed production overhead again, because you've already used it to determine your over and under absorption, right? You've also used it to charge your production cost as what? As full cost, right? So now we don't have that. So we have the under absorption. So it is a cost to the firm. So the cost need to source for this for them to be able to meet up with what? With the 300,000 naira budgeted for, right? So this is what? this is 200, why this is 200,000, right? Why this is what? 80. Right? So what is the difference between this? So this is supposed to be 640,000. Right? This is what? This. Right? So what do we have here? So I need to clean this part. This is 145. 145. Okay? This is 145. $145,000, and this is what? The profits, right? This is the profit, the actual profit for the year or for the month. Okay, for the year, because this is for the whole year, and this is what? 560, right? This is 560, and this is the what? The actual profit for what? For the year. And this is all about absorption costing, right? You can see that this is very simple, right? Just follow this format, and you will see more of over and under absorption as we proceed. So now the next thing we need to look at is what? Is the reconciliation, because sometimes when you are doing your what? Marginal and absorption costing, and you want to do the reconciliation, you want to know if your profit statement if your profit is actually correct or not. You need to do what? Reconciliation. So this reconciliation will enable you to know, we let you know that, oh, you actually arrive at the what? The correct what? Profit. Now let's quickly look at reconciliation. Reconciliation, right? So reconciliation.